All right, let's talk about gold. But today, we're not going to treat it like some speculative bet, a way to get rich quick. No, we're going to reframe this completely. Think of gold as something much more fundamental, a strategic insurance policy for your portfolio designed specifically for long-term wealth preservation.
And that brings us to the big question on every investor's mind right now. After an absolutely massive 50% rally, gold has pulled back hard. So, what's the deal? Is this the golden opportunity to get in at a discount? Or is it a trap waiting to spring? That's exactly what we're going to unpack today.
So to get our heads around this, let's just look at the cold, hard numbers. This really sets the stage for our whole conversation. You can see that incredible 50% run-up over the last year, but, and this is the important part, look at the more recent numbers. It's down about 11% from that peak we saw just a few months ago. This is the push and pull we have to navigate.
Okay, so let's start by building the case for owning gold in the first place. Think of this part as us going over the coverage benefits of our insurance policy. What exactly are we insuring our portfolio against?
Well, number one, without a doubt, is geopolitical risk. Gold is your portfolio shield. Even when we see temporary ceasefires or a bit of calm, the underlying friction around the world, that's not going away. And when things get tense, where does money run for safety? It has always been gold. It's the ultimate safe haven asset.
Now, this idea of safety leads to a really important concept for any long-term investor, something called a structural price floor. And this isn't just some line on a chart. It's a real, fundamental base price for gold that's supported by huge, consistent buyers who are always there, preventing it from crashing. So, who are these buyers?
Well, here they are. A massive 25%. A full quarter of all gold demand on the planet is coming from central banks. And the why here is what's so fascinating. They are deliberately moving their reserves away from the US dollar and into gold. This constant, large-scale buying, this is what creates that safety net, that price floor we were just talking about.
And there's a really timely cultural factor in play too, especially if you're in India. The festival of Akshaya Tritiya almost always brings a huge spike in demand for gold. And this year, that seasonal buying is happening right as the price has taken a dip. Analysts are calling this a healthy pause in a much longer uptrend, which suggests that right now could be a really smart entry point.
And hey, don't just take my word for it. The big players on Wall Street are still very much on board. You've got major banks like Goldman Sachs and UBS projecting some serious upside for gold by 2027. That kind of long-term optimism reinforces the idea that the underlying trend here is still very, very positive.
Okay, but it can't all be good news, right? Every insurance policy has exclusions and fine print, and every investment has risks. So to be smart about this, we have to look at the other side of the coin. Let's talk about the potential headwinds for gold.
The biggest risk, gold's main weakness, its kryptonite, is a strong US dollar. It's a classic inverse relationship. Think of it like a seesaw. When the US dollar index, which basically just measures its strength, goes up, the price of gold tends to go down. Why? Because it simply takes fewer of those stronger dollars to buy an ounce of gold. And that brings us to the idea of yield competition. Here's the thing about gold. It doesn't pay you anything, it just sits there. Now, when interest rates are high, you can get a really nice safe return from government bonds. So if you're a conservative investor looking for income, the choice is pretty clear, right? That can pull a lot of money out of gold and into bonds.
And finally, we just have to be honest about what's been happening lately. A 20% drop from a peak technically means gold entered a bear market earlier this year. So let's be clear, we are not buying into a market that's in the middle of some explosive rally. We're in a correction, and that calls for a much more careful and patient strategy.
All right, so we've looked at the good stuff, the coverage, and we've read the fine print, the risks. So how do we actually write this policy? Let's put together a simple, actionable strategy for using gold just for what it's good at, wealth preservation.
So how does this look in practice? This is absolutely crucial. Gold is just one piece of the puzzle, not the whole thing. To do its job as a stabilizer, experts recommend a really disciplined allocation of just 10 to 15%. Any more than that, and you start giving up too much growth potential from your other assets.
Okay, so how should you own it? Well, for residents in India, the answer seems pretty clear. Sovereign gold bonds, or SGBs. And here's why it's kind of a no-brainer. You get all the upside from the price of gold going up, plus the government pays you an extra 2.5% in interest every year. that gives you a much higher real return than just holding physical gold, which, remember, pays you nothing.
And finally, here's the playbook, the execution plan. It's 3 simple steps. First, do not just dump a huge lump sum of cash in, especially after the huge run-up we've seen. Second, you have to change your mindset. See these price dips not as scary events, but as opportunities to buy in. And third, put it all together with a dollar-cost averaging strategy. That just means you invest smaller, fixed amounts over time. It lets you build your position patiently without trying to perfectly time the market.
So let's end with this. When you weigh the incredible rally, the very real risks, and the smart strategy to manage it all, the conclusion for a long-term investor is pretty clear. Gold isn't about chasing crazy returns. It's about providing stability. And in a world that feels increasingly volatile, that makes it a mandatory insurance policy for your family's financial future.